welcome to episode 23 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I just wrapped up my first year at the University of California, Los Angeles.
On this podcast, we will discuss an update related to the zombie biotech company Keros Therapeutics, a potential or rumored deal for the trucking company Foward Air, a non-binding proposal to acquire the avocado producer Calavo Growers, the merger of two German biotech companies, the breakup of Warner Brothers Discovery into two companies, a stock buyback announcement by buybacks, two highly unusual insider purchases, and a whole lot more. Feels like we have a lot to cover this week.
Yep. As a reminder, nothing discussed in this podcast should be regarded as investment advice, but please go ahead and listen to our full disclaimer at the end of this podcast.
If you have been enjoying this podcast, do us a huge favor and take a moment to like, subscribe, or rate this podcast on whatever platform you might be listening on.
We'll start this episode off by diving back into zombie biotechs, a concept we've discussed twice on this podcast, both in episode 14 and also in our interview with Chris DeMoot Jr. Just to recap, zombie biotechs are biotech companies that are flush with cash on the balance sheet and trade below net cash, often because they aren't making any scientific progress.
When talking about zombie biotechs, we specifically decided to highlight Keros, a clinical stage biopharmaceutical company, which announced that it is exploring strategic alternatives, including a potential sale, and at the same time adopted a poison pill provision to prevent any hostile acquisitions. The conflicting actions were quite fascinating to us, and we dived a little deeper into the company during episode 14.
We wanted to provide a quick update about Keros itself. The company ultimately decided not to sell itself, much to the disappointment of investors who were hoping to see the company wind down operations and return all cash to investors. Instead, the management team has decided to return $375 million of excess capital to stockholders. The manner in which this capital is to be returned is yet to be determined, as is the date of when this capital is to be returned.
So it seems like a minor win for shareholders. Keros has a cash position of around $720 million on the balance sheet, so the company is only returning a little over half of that capital to shareholders, meaning they still have a significant cash position to burn against a market cap of approximately $550 million, and not even taking into account some of the milestone payments they're supposed to receive, if I'm not mistaken, later this year.
Yep. So not a full win, as most investors I think were hoping to receive all that capital at the end of the day.
Indeed.
Moving on to another deals in the works, private equity firms including Blackstone and Apollo Global Management have expressed interest in acquiring the U.S. trucker Foward Air.
We added this deal as a potential deals in the works in August 2024 after the activist investment firm Ancora, which owned a 4% stake in the company, started pushing Foward Air to consider a sale. Quite frankly, I have to say I'm very surprised that a PE firm like Apollo might be interested in buying a trucking company, which usually is known for low margins and being an asset-heavy company, if you will.
Exactly. Foward Air is an expedited less-than-truckload, or LTL, trucking company that lost nearly half of its value in 2024 after it completed the $3.2 billion acquisition of Omni Logistics. The stock was trading at $120 before the Omni acquisition was announced and currently trades at just $20 and change. The drop in the stock price was partially the result of the company reporting a string of losses following this massive acquisition.
So yet another example of a company doing a massive acquisition and then having indigestion issues as they try to digest this massive acquisition. There was mass exodus at the C-suite level of Foward Air, with the CEO leaving in February 2024, followed by the CFO, the Chief People Officer, and the COO. The whole situation reminds me of Heartland Express, another trucking company, which is a full truckload carrier, compared to Forward Air being a less than truckload carrier. And we had covered Heartland Express in an Insider Weekends article in 2023 because of multiple insider purchases by the CEO. While there wasn't much management turnover at Heartland, a series of acquisitions, including that of Contract Freighters in August 2022 for $525 million, left the company with a leveraged balance sheet, and Heartland reported a string of losses after that.
Continuing to compare the two companies, Forward Air has a market cap of $615 million and an enterprise value of $2.72 billion, so massive debt balance there. In contrast, Heartland has a market cap of $683 million and an enterprise value of $865 million. Heartland trades at a forward EV by EBITDA of under 6, and Forward Air has a forward EV by EBITDA of around 9.
So after I looked at this data, I was actually quite enthusiastic about Heartland and did a deep dive on it this morning. And I found that they've been doing a great job of paying down the debt that they took on as a result of those acquisitions. But quite frankly, their organic business is shrinking quite a bit. So unless we start seeing a turnaround on that front, it's not as exciting as I initially thought it might be at a low valuation and the fact that the debt on the balance sheet was reducing. So going back to what we were just talking about, why would a PE firm want to buy an asset-heavy trucking business? One of the reasons could be that Forward Air is sorely in need of a turnaround because Ancora estimates that its yields were 32% below the market. So they have a lot of capacity that is not getting filled, if you will. The other reason is the entire trucking industry could benefit from a combination of self-driving technology and electric trucks. We often see trucks struggling on mountain passes in both California and Oregon, and electric trucks, whether they are self-driving or otherwise, could make things a little easier on those steep roads. On a recent drive from LA to San Francisco, I saw a bright yellow Frito-Lay Tesla truck, the first Tesla truck I've ever seen. At any rate, if a deal materializes for Forward Air, it could be positive for other trucking companies like Heartland Express in this highly fragmented industry that could potentially use some consolidation.
Absolutely. We've been keeping up with Heartland Express for quite some time, so it's interesting to see this other trucking company come to light and face this acquisition interest. Moving on to a couple other deals in the works from the last few days that we quickly wanted to cover. We're going to start out with the avocado producer Calavo Growers, which received a non-binding proposal to acquire all outstanding shares of the company's common stock for $32 per share. We've talked about Calavo in past episodes. The company announced a small $25 million buyback in March of this year, representing about 6% of the company's market cap at announcement. We've also seen insiders purchase from time to time. The most recent purchases were from April of this year.
Calavo currently trades at $27.66. So this cash plus stock deal that values the company at $32 does represent a fair premium. However, the board is currently reviewing the deal, and as is the case with all deals in the works, there's no definitive answer that states this deal will absolutely go through.
Keeping this food M&A theme going, Apollo Global Management and a Qatari investment fund, Earth Capital, have made an offer to take Papa John's private. Earth Capital is still struggling to find financing reportedly, so Apollo might go for the deal alone.
This restarts discussions from way back in 2018 when the pizza delivery company reached out to potential acquirers, and Trian Fund, Bain Capital, and CVC Capital made offers at the time, but the talks fell through.
Apparently, the current bid made by Apollo and the Qatari Fund was in the low $60 per share range, and Papa John's currently trades at $50.42. So again, there's a pretty fair premium to pick up if the deal materializes at that $60 range.
It's funny how we see all these potential deals and offers, and you see the companies turn down those offers, and inevitably a majority of them end up trading well below that offer price. I think you're probably thinking of Lionsgate Entertainment and the Hasbro offer. And we've seen so many of these things.
That's the go-to always. $40 Indeed. Hasbro offered, and then Rachesky turned it down, saying it was too low, and then the company began trading at anywhere between the $5 to $10 range.
Time and time again, we keep seeing this happen. Management teams should just decide that it's in the best interest of shareholders, in some cases, to take these offers. Not always, but for the most part. Last but not least, let us wrap up our deals in the works segment by talking about the telecommunications company Telus Corporation, which is proposing the acquisition of all outstanding shares of Telus International that it doesn't already own for $3.40 per share, payable in cash. Telus Corporation common shares or a combination of both.
Telus Corporation already owns 60.1% of Telus International, so this deal already has majority approval, but Telus International is currently trading at $3.61, about 21 cents above the deal price. So it's likely that the minority investors are trying to squeeze out a little bit more from Telus Corporation in the hopes that the deal price will be revised upwards. Will that happen? Maybe, maybe not, but we'll see going forward.
We have seen that happen in the past with situations where there's a majority owner trying to buy the other part of the company it doesn't own, and minority shareholders are able to negotiate a slightly higher price. So this negative spread, if you will, where it's trading above the potential acquisition price, makes a whole lot of sense.
But then again, when it came to the Endeavor acquisition, that was trading at a negative spread. The deal ultimately went through at a loss for those investors who had invested above the agreed upon price, as the minority investors weren't able to drive the price up further, right?
That was an excellent counterexample where somebody did own an majority stake. But then again, you have to remember the Endeavor deal had Silver Lake Capital involved,
Right.
and they aren't likely to, give in, if you will, as easily as others have in the past. As for newly announced M&A from this week, the German biotech firm BioNTech entered a merger agreement with its domestic peer, CureVac, in a deal valued at $1.25 billion. Under the terms of the agreement, each CureVac share will be exchanged for about $5.46 in BioNTech American Depository Receipts, or ADS or ADRs as they're called, representing a premium of about 34.15% from the stock's last close.
However, the deal is subject to a really interesting collar mechanism, and this collar mechanism is going to be wordy, so bear with me for a second. But if the 10-day volume weighted average price of BioNTech, and these are the ADRs, exceeds $126.55, the exchange ratio will be 0.04318. And if the weighted average price is lower than $84.37, then the exchange ratio will be 0.06476.
Yeah, we see these collar mechanisms from time to time, and essentially what they're doing is, if it's an all-stock deal, they're saying, hey, if my company's stock goes up a lot, we'll give you less of it. And if my company's stock price drops a lot, we'll give you a little bit more of it to make up for that. So these require a little bit additional monitoring to see where the actual spread might be, and that makes them interesting at times.
Exactly. I think the last time we saw this was with Spirit Aerosystems, and then Boeing.
I think so. That's the last example that comes to mind. Both these companies work with messenger RNA or mRNA technology that has been both praised as well as vilified by some people, if you will, developing vaccines and therapies for cancer and infectious diseases. The deal also marks an end to a long-standing rivalry between BioNTech and CureVac, which peaked during the race to develop a COVID-19 vaccine. BioNTech partnered with Pfizer to bring their vaccine to market, while CureVac's vaccine faltered due to lower effectiveness rates during trials.
CureVac began to focus exclusively on cancer therapies about a year ago, after selling their flu and COVID-19 vaccine programs to their partner GSK. CureVac had also sued BioNTech for IP rights and IP infringement in 2022, a legal battle that will be resolved if this acquisition is completed, because at that point BioNTech will own CureVac. Regulatory approval for this deal isn't expected to be a significant hurdle, especially considering that the German government has already expressed support for the deal in the hopes of creating a new German biotech leader.
It's also interesting that the German government actually owns a stake in CureVac, And they probably want to see both these biotech companies come together and lead some research on the oncology side of things, which is kind of what Pfizer did with its vaccine money as well. They went on an acquisition binge, including certain oncology focused biotech companies. Switching gears a little bit to spin offs, on our last podcast, we discussed David Zaslav's more than $50 million pay package at Warner Brothers Discovery that was voted down by shareholders in what was essentially a symbolic, non binding vote. So, the company doesn't actually have to do anything to his pay package. It was just a symbolic vote that doesn't hold the company to any action, if you will. We talked about the disastrous merger of Warner Brothers with Discovery, which left the combined company with a highly leveraged balance sheet.
Last week, we received some additional details about the Warner Brothers Discovery decision to spin off a part of the company. The company will be spinning off its digital streaming and studio operations, which will include Warner Bros. Television, Warner Bros. Motion Picture Group, HBO, DC Studios, and its valuable TV and film libraries.
I wonder if they're going to go back and try to figure out whether they should call it HBO, HBO Max, Maxer HBO, and all the different names they tried and that didn't work out. Anyways, going back to what will be left over after the spin-off, the RemainCo, called Global Networks, will include most of its cable TV properties like CNN, TNT Sports, Discovery, and it looks like they also have some free-to-air channels in Europe and the Discovery Plus streaming service and Bleacher Report. At first look, it looks like all the attractive assets will be in the streaming and studio spin-off, and this Global Networks section, the RemainCo, doesn't look quite as attractive.
I mean, that is what we thought when Lionsgate Entertainment went through a very similar separation by spinning off its studio and library into Lionsgate Studios, and then the RemainCo parent company was renamed Starz.
So far, we've been proved wrong because in the 5 weeks since that spin-off, Lionsgate Studios is down 22%, while Starz is up 53%. Getting back to Warner Brothers and Discovery, they haven't yet hired an investment bank, and the expected spin-off is supposed to complete sometime in mid-2026.
David Zaslav, the current CEO of Warner Bros. Discovery, will serve as the president and CEO of the streaming and studios business, while the company's current CFO will serve as the CEO of the global networks business. I wonder if that pay package will change at all, or if it'll only grow bigger now that he's only managing the streaming and studios business.
You should expect it to shrink because it's a smaller company at this point, but you never know. He's been known to have a very large pay package even before the merger of Warner Brothers and Discovery. And the other thing that's interesting is we saw the same thing happen with Lionsgate, where the current management team mostly ended up going to the streaming Lionsgate Studios division and they didn't stick around with Starz. Post-separation, Global Networks will continue to own a 20% stake in the streaming and studio spin-off, and at some point they plan to monetize that 20% stake and maybe pay down the debt. We don't know how much debt each of these companies will have post-separation, and I look forward to analyzing the situation more as additional details emerge.
Transitioning over from spin-offs to buybacks, we wanted to briefly discuss a key buyback from this week, which was the production theater company IMAX announcing a $100 million buyback representing 6.51% of the company's market cap at announcement. This is an increase to an already existing share repurchase authorization from 2022, bringing the total share repurchase authorization to $500 million, of which approximately $250 million remains available.
IMAX is up 84% in the last year alone, and the company has surprisingly good gross margins of 54.62% and almost 7% net margin. Revenue and net income were growing on a year-over-year basis, but the company did take a slight hit in 2024. We've had a couple of standout movies throughout the last year, including Sinners, the new Mission Impossible movie, the Minecraft movie, and more, which could have contributed to IMAX's stock performing so well recently. Although, quite frankly, I wouldn't imagine the Minecraft movie being a good fit for IMAX, although Mission Impossible would be fun to watch on IMAX.
True, but the Minecraft movie I think was one of the highest grossing movies this year so far. So I wonder if some of that made it through to IMAX.
It's just probably going to look more pixelated on the large screen, is what I was thinking.
Maybe not.
Indeed.
But yeah. Moving on, there were two key insider purchases that caught our eye this week. We've been talking about Quanterix and its attempts to acquire Akoya Biosciences despite vocal opposition from investors and activists alike, pretty much every few episodes at this point. This week, we saw 3 different insiders of Quanterix purchase shares of the company, including a purchase by director David Walt, who, in addition to being a professor and researcher at Harvard Medical School, was also a co-founder of Quanterix and is responsible for developing the company's key technology platform, the Simoa detection technology for early-stage identification and prevention of diseases.
It's clear that management is very enthusiastic about this deal, even though the market seems very opposed to it. We also saw the new chairman of the board, William Donnelly, purchase shares, having been appointed to this position in March of this year after serving as a director since August 2023. Mr. Donnelly was appointed to this position after the old chairman stepped down in March of this year after not receiving enough votes or support in the company's annual elections.
And I wonder how much of that was tied to everyone opposing the Akoya Biosciences deal.
Indeed.
We also saw the president and CEO of the company purchase shares. So again, management is very, very interested in this deal. Another thing to note is that David Walt also co-founded Illumina, so he has a very big background when it comes to life sciences and biotech companies. So from a scientific perspective, this acquisition might make some sense, but from a financial perspective, less so. Quanterix currently has a cash balance of $267 million against a market cap of around $235 million. So I can see why investors might be more inclined to have the company return capital to investors rather than spend it on unprofitable acquisition, as Akoya is not making any money, which will only make Quanterix's existing net losses even worse.
I really liked your write-up about this situation for our Insider Weekends article that we published on Sunday. And I think one of the things you mentioned there was the combined company expects their total addressable market, or TAM, to increase from $1 billion to $5 billion. So maybe that's the reason the insiders and the people who really understand the science behind this thing are excited about the deal. But investors who probably don't have that much visibility into what might happen a year or 3 years from now are not quite excited about them using money to buy another money-losing life sciences company. Going beyond Quanterix, we also saw a fascinating insider purchase by director John Paulson at Bausch Health Companies, a company that was once known as the Enron of Pharma, back when it operated under the name Valiant Pharmaceuticals.
The company, founded in 1959, had turned into a pharmaceutical giant known for its roll-up strategy by the 2010s, where acquisitions of smaller companies became the name of the game. Bill Ackman had started a position in the business in early 2015, but by the end of the year, a short report was released by Citron Research, calling the company toxic and highlighting its mountain of debt it had added by completing all these acquisitions.
I remember Bill Ackman talking about this whole situation on Lex Friedman's podcast. I think he had this 3-hour podcast where he talked about the big impact being long Valiant Pharmaceuticals had on his fund and on his personal life as well. Coming back to Valiant, soon after the short report was released, the company delayed releasing quarterly results due to accounting problems. Legislators also got involved due to accusations of price gouging patients, and a criminal investigation was launched by August 2016 that concluded with former Valiant executives being charged with fraud, which, as you know, doesn't happen all that often. By 2017, Ackman has sold his stake in the company after suffering a nearly $3 billion loss, and the company sold its skincare brands like CeraVe to L'Oreal for $2 billion.
The company renamed itself to Bausch Health Companies in 2018, and then spun out the eye health and contact lens maker Bausch and Lomb in 2020. The parent is down 62% roughly since the spinoff, with Bausch and Lomb down about 38% since the spinoff.
So neither the parent nor the spin-off did well, despite the whitewashing of the name from Valiant Pharmaceutical to Bausch Health companies. As it stands today, Bausch Health Company still struggles with maintaining stable and consistent profits and has a massive debt balance of $21.5 billion against a market cap of just $2.21 billion, so a highly leveraged company. This is why the purchase by director John Paulson is confusing. We're not quite sure what he's seeing in the company, but clearly the market is happy. The stock has risen over 18% since his first purchase last week.
The market paying attention to John Paulson isn't all that surprising. One of the first books I ever read about investing was The Man Who Solved the Market by Gregory Zuckerman. Mr. Zuckerman also wrote a book called The Greatest Trade Ever, which tells the story of how the hedge fund manager John Paulson, who actually had a background in special situations and M&A, bet against risky mortgages in 2006 and onwards, accurately timing the implosion of the housing market and the Great Recession, making more than $15 billion for his firm.
Mr. Paulson then went on to invest very heavily in gold, something he remains invested in today, if you look at the snapshot of his portfolio as provided by his 13F filing. It is also important to remember that after the greatest trade ever, Paulson bet on rising inflation, and his investments in gold didn't play out the way he expected, leading to years of subpar performance. After a 26-year run, he returned external capital to investors in 2020 and converted the firm into a family office.
He still files these 13Fs though, so we can still glean some insights. And a couple other interesting insights from this 13F filing is that over 40% of his portfolio is invested in a single company, Madrigal Pharmaceuticals, and that Bausch makes up about 7% of the portfolio. Naturally, a purchase from an insider with a pretty successful track record who has been with the board since 2017 is a good signal, but we're not fully seeing the thesis when it comes to a company with such a massive debt balance and then slowing revenue growth as well.
Yeah, quite frankly, this happens very frequently where we look at insider purchases that make absolutely no sense to us from the outside. But every once in a while, I think the insider has some very deep insight about something that is going to happen that we as observers from the outside really can't pick up until the event comes to pass. Moving on to activists, the Idaho-based potato company Lamb Weston is back in the news. Unlike the name, the company has nothing to do with lambs. Lamb Weston is the world's largest frozen potato products manufacturer. So if you're eating French fries at a restaurant, it is quite likely a Lamb Weston product. The company was a successful spin-off from Conagra Brands in 2016 and initially did quite well, outperforming the S&P 500 by over 100%.
However, the company soon lost its way, and the stock, which was trading at over $115 per share 2 years ago, now trades at just a little below $55 per share. JANA Partners initially got involved with Lamb Weston in October 2024 when it announced a 5% stake in the company and then increased their stake to 11% by February 2025.
Maybe JANA Partners will eventually convince them to start selling lamb instead of just potato products, but that's yet to be seen. Last week, JANA Partners entered into a nominee agreement with Robert Bradshaw Henske, the former CFO of Intuit and Synopsys, to nominate him to Lamb Weston's board. It's interesting to see that they would want somebody with technology experience to be on a potato products company's board.
Yeah, I was about to say, very interesting background there. I'm not seeing the exact crossover. Maybe JANA Partners is trying to turn it into a technology company instead of a potato or lamb company. All right, moving back to activists and enough about potatoes. We saw the activist firm Stillwell Value sell shares of Provident Bancorp after its merger announcement with NB Bancorp. We just wanted to point this out real quick, considering we talked about NBBK just last episode, and given that the deal is an all-cash or stock deal, it looks like Stillwell was happy to exit right now and didn't want shares of NBBK or the combined company in the future.
And so the reason this is interesting to us is Stilwell Capital, and Joseph Stilwell is one of the best regional bank investors that we know of. And his decision not to stick with the combined company is a signal that maybe he doesn't see this as a very positive development for NBPK or Provident. But let's see how that plays out. We're going to conclude our activist section by highlighting the fact that the activist hedge fund Parvus Asset Management is building a stake in Ozempic maker Novo Nordisk as it wants to influence the appointment of Novo Nordisk's new CEO. Last month, Novo Nordisk announced that its CEO plans to step down sooner than originally planned. The London-based hedge fund did not disclose how much of Novo Nordisk it acquired.
To wrap up our podcast today, we wanted to talk about two C-suite transitions that at the end of the day were just one C-suite transition. Paramount Global saw its CFO, Naveen Chopra, suddenly resign from his position, with his time at the company ending at the end of this month.
Mr. Chopra had been the Paramount CFO for nearly 5 years, and the stock was down over 50% during his tenure. Paramount, and I'm referring to Class B shares here, is actually up 21% over the last year. So it's definitely recovered slightly because of all the potential acquisition situation that was going on with multiple parties interested. But it is still struggling with a massive debt balance that is nearly double its market cap.
Naveen Chopra is leaving Paramount to join Roblox as its new CFO, a stock that is up a whopping 170% over the last year. The meteoric rise is not surprising at all to me personally. I've seen Roblox continue to be popular among all age groups, including college students, oddly enough. So the aging out concern seems to be not all that significant. That too, with more and more young children having access to devices, Roblox's addressable market is certainly increasing quite rapidly.
That's actually a very interesting insight because I had originally expected Roblox only to appeal to middle school or elementary school children and no one over the age of 13. So to hear that college students are still playing Roblox game is very surprising to me. The company has maintained pretty strong revenue growth over the last few years, and it looks like the net losses are reducing over time as well. I'm interested in seeing what Mr. Chopra will achieve at Roblox, especially considering his impressive track record. He served as the CFO of companies like TiVo, Pandora, Amazon Devices and Services, and more.
And with that, we will wrap up episode 23 of the Special Situations Report. As always, what we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com. We also wanted to provide a reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice, and we do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
If you made it so far and listened to the disclaimer as well and enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.